Last year, COMEX, which normally only deliveries are normally only about 10,000, 15,000 contracts. Last year it was 90,000, which is 450 million ounces. That's more silver than they currently have at COMEX combined, I think, for eligible and registered. 450 million ounces delivered last year. This in January this year, it's going to be somewhere between 30 and 40 million ounces. We don't know yet, early in the month. But if it stays on that pace, it's untenable, unsustainable. We can't stay at 30, 40 million ounces a month. Now, each month, they have what's called major delivery months, and you don't have those every month. There's only like 5 of them each year. Those are the major months, which January is one of them. But even the off major months like February, you can still do deliveries in that month. You know, it's still doable. And so we could see more. We could see sustained deliveries even in February. We'll see what happens. But LBMA has been having trouble with inventory with silver. Shanghai, they only have 40 million ounces. That's the estimated available. That's not very much. So, you know, I think my 400 million ounces is probably too high, which again, it's not very much. 400 billion.
Don Durrett says silver's big rally is not really about silver, but about gold. Silver is now seen as a monetary metal, not just an industrial one. This is creating a supply squeeze as investors compete with fabricators. There is very little physical silver available, and COMEX deliveries are extreme. However, gold is moving with the stock market, and when the S&P corrects, gold and silver will also fall. Durrett says 2026 ends easy money, and a dip in March or April is likely. Thanks for watching. Give a thumbs up and subscribe to Fine Metals for the latest insights.
Silver's up 100% since the beginning of August. 100%. I mean, unbelievable. Finished the year at $70, up 142% on the year, and is up 10% from the first of the year. End of the year at 70, it's at 79 today, up another over 10%. Gold's up 5%, HUI's up 10%. So the HUI isn't outperforming silver and gold. It's like the miners continue to lag because nobody really believes this breakout. I'm not surprised here, but the one thing I want everybody to realize is that this really isn't about silver. This is about gold. Gold is such a much larger market than silver. Silver's teeny tiny. I mean, I'm updating my book right now, the 12th edition, and I estimate there's only about, and I might be high on the high side, 300 to 400 billion dollars worth of 1,000 ounce bars that are actually available. I mean, it's a nothing burger. I mean, we're not even talking into the trillions, the silver inventory level that's out there. And then if you want to buy it, I mean, good luck finding it if you're trying to accumulate. The S&P 500 is kind of the stock market is the economy kind of thing. The S&P 500 has been trending higher. Look at that strong chart. Gold has been correlated, and it shouldn't be, since February of 24. So for 2 consecutive years, they basically have been correlated, ripping higher, which is unheard of.
With the S&P?
Yeah, the S&P and gold, they've been correlated. Gold is basically having a love affair with the S&P. You go higher, thank you very much. I'm coming with you. So gold has corrected a few times, more so than the S&P over the last 2 years. And every single time that gold's corrected like $100, somewhere in that range, it's turned around and went right back up following this S&P. And so as long as the S&P continues to trend, gold will continue to trend and silver will continue to outperform, because silver's in its outperform mood right now. But if the S&P falls back, the odds are very, very good that gold and silver fall back. So S&P's the leader. S&P's is basically setting the pace, and gold's following the S&P, silver's following gold. And I firmly believe that people aren't going to get a free ride here. So if you look at, silver, I mean, it's actually up 140%, 100% in the last 6 months. People that have been jumping on this thing thinking it's an easy trade, I'm just going to make money. That's not how these things work. These bull markets, they buck, and it's not, you're going to have to get your seatbelt tight and hang on. So a lot of people right now are really bullish coming out of January, this first month. So you got the S&P strong, and you have the economy, we're going to get into this, appears to be strong. I mean, let's just go down the list of the acts of desperation. And this is what I'm saying about how the U.S. economy is in trouble here, and all this bullishness is misplaced. So the first one, of course, was the tariffs. Republicans are supposed to know that tariffs are a tax. Tariffs are actually slow economic growth, slow the economy, right? But it's an act of desperation. Trump needs the income. But imports went down. So if imports have went down significantly, guess what else went down significantly? Retail sales, because those goods never got on the shelves, right? So Target's going and Walmart's going, wait a minute here, we don't have as many goods to sell, right? $2 trillion deficit, the big beautiful bill. Trump signed off on that and said, okay, we're going to call it the big beautiful bill. Big is in capital B, right? Big spending bill, right? That was another act of desperation. Instead of him cutting costs, cutting the budget down to like 1.5 trillion and cutting 500 billion out, he basically said that, no, that's too painful, right? Act of desperation. We're just going to do 2 trillion. We're not going to cut it all. We're going to increase spending, right? Venezuela. Going into Venezuela, that was, nobody expected that one, right? That was
he was kind of telegraphing it for a while.
Yeah.
Maduro were going back and forth.
6 months.
But yeah, I mean, it just happened so suddenly.
This is all about gold and what's driving gold. And so what's happened here is silver, until this year, has basically been perceived as a base metal, as a fabrication metal, not as a monetary metal. And I basically have said it's just a matter of time. And that was basically the cup and handle of all cup and handles. That was always been my favorite chart, is that eventually silver will be perceived as a monetary metal following gold, which is what's happening here. And once it turns into a monetary metal, you get the squeeze of the GSR, the SGR. And so those were down to like 60, probably sub 60 now. Do we go sub 60 today on the GSR? The SGR is about 1.8 at 2%. I think we're going to 2.5, 3. The SGR I think is going 40, 30. So that the reason why you get the squeeze is because it becomes a monetary metal. And then once it becomes a monetary metal, then people are buying it as investors. So investors are squeezing out the fabricators. So the fabricators normally would want about 75, 80% of supply, and they kind of still do. And so what's happened is that we've had these 100, 200, this year, maybe 300 million ounce deficits. All those deficits is all because the investors are showing up and saying, I want some too. So I've always said that, when I first wrote my book back in 2012, I said that eventually you're going to have a shortage because the investors are going to come in. And once the investors come in, there's not going to be enough to go around because the demand for fabrication is not really going to crash. Even if it goes down a little bit, the investors will kind of swallow all that up. So that's what we have now. We have kind of it's becoming a monetary metal, and you're having a lot of demand from investors, which isn't going to stop. It's right now, it's about 65-35. You have 1.2 billion ounces of supply, about 200. They're saying maybe we go to 1.3. Supply is only 1 billion ounces. So they're thinking maybe demand might jump to 1.3 this year, which would be another, mostly investors jumping up another 100 million ounces. So nobody has any fear right now. It's basically, I've heard somebody call it a complacency market. I think it was Casey, Gary Casey called it complacency. And
Mm.
absolutely, people are way, way, way too complacent here, thinking that everything's fine. Everything's fine. Listen to Ray Dalio, and you'll get educated real fast that everything isn't fine at all. We're not even close to fine. As a matter of fact, we're in the danger zone. I mean, if you listen to Jim Rogers is like, the business cycle didn't go away, people. Be very, very careful. And so some of these guys have been around a long time. Warren Buffett, the Buffett indicator, he's all in cash. He's like, this is. If everything was so rosy, right? Wall Street is trying to tell us right now that everything is rosy. Atlanta GDP has got the GDP at 5%. I mean, it's total baloney. If the economy is growing at 5%, people would be getting hired. People aren't getting hired today. Good luck getting a job. And so Buffett's not buying. It's all rosy. It's everything's great. Let's go buy stocks. No, it's not. There's fundamental problems here. And so my point is, kind of the Jim Rogers, be very, very careful, buying tops. You don't want to buy tops. You want to buy dips. And I think there will be a dip opportunity the first half of this year. I think it's going to happen in March or April. But we can't afford interest payments at 6. As a matter of fact, at 5, it's basically a flashing red light if the 10-year goes to 5. But you go to 6, and it's like, kind of, that's what I'm talking about, the fragility. The fragility becomes very, very obvious when the 10-year gets above 5. Very obvious. It's like, if you're holding 10-year, 20-year, 30-year bonds and interest rates go to 5, you're losing your butt. Because when rates go higher, you lose money on bonds. And so people are going to be dumping them. They're like, okay, I'm out of here. I'm losing enough money. Once you get to 5, people are going to dumping. And every point that it goes up, 5.1, 5.2, 5.3, 5.4, you're losing more money. This is all coming to an end. And the reason why, and I really believe it, 26 is the year that Easy Street ends, because 26 is the year that everybody realizes my thesis is going to play out. And once the bond market becomes fragile, and fragility is when these weekly and monthly auctions start basically not going our way. People don't show up. That's fragility. And fragility will begin as soon as the recession begins. And this is why I like what Dalio's been doing. I like people that educate the public. I like to educate the people public. Dalio's been doing that too. He's been putting out these podcasts, and he's basically educating people and basically saying, you need to get ahead of this. Dalio sees it as well as me. And Dalio, I mean, that guy's brilliant. He's a lot smarter than I am. And I really, he really lays it out. He's like a professor. He's just, really methodical the way that he lays out the economic problem that we have, that we're in. And he basically says, kind of like me, there's no solution here, people. We're screwed. There really isn't. So what I've been saying is that there's only one outcome here, and that's a reset. And that reset is not going to be favorable. This is the key thing here. A reset will not be favorable. This is a bankruptcy redo. This is the U.S. government, U.S. economy going bankrupt,